Hi, my name is Doug Robinson, and welcome to this short little video on my most favorite subject, and I really hope it's yours also because it's all about you with a little bit of sex and money thrown in, because of course you can't talk about demographics and how it relates to the economy without of course knowing when your population is born, and particularly what they do as they age and as they spend money and save money. So where's a great place to start talking about how demographics relates to economic trends? Well, right here at the beginning. You can see by this chart, this is taken from U.S. Census and immigration data, that shows when U.S. citizens and immigrants to the United States were born. Now, births here in the United States didn't happen all in a straight line. There was waves of births, if you will, and we can call them generations. You can look over here on this far left, the first generation here in the United States that we want to count. Here is what we call the Bob Hope generation, peaking about 1920, followed by a bust into the 1930s, the Depression era, followed by then the most enormous generation or boom in U.S. history here between 1936, peaking in 1957 and 1961, and it's a generation we all refer to as, well, you're looking at one of them, the baby boom generation. Massive generation, peaking then in 57, 61, followed by a baby bust. And then around the early 70s, 75, 76, we started this next generation, the baby boomers' kids, or the echo boom generation, which peaked, a first peak about 1991, followed by a bust in 1996, which then resumed course to about right now, where you can see up here, 2007 peak. Then, of course, it declined since we had this great recession here. But that won't last for long. We'll get into that as we go. But what's important for you to see in this chart, like I said earlier, we've had these waves of generations, waves of births here in the United States. And these births have had, with all these kids growing up, becoming productive adults, consuming items, spending money, have had the most profound effect on our economy. Now, we know this maybe intuitively. As you age, you spend more money. At some point, you don't. But we do have some statistics available through the Bureau of Labor's Consumer Expenditure Survey, the Bureau of Labor Statistics. And they know pretty much everything about us. They know what we buy, where we buy it, down to neighborhood block, particularly know at what age. So again, you may not need a chart like this to tell you what you probably already intuitively know, but here it is, and this is of average age. So don't feel bad that as I walk you through this chart that you go, oh my God, I'm completely average. I know I've hit every one of these marks. So look, at age 18, what do you have? Nothing, right? You enter the workforce in your early 20s. You finally move out of your childhood bedroom, off of your friend's couch. You get that first apartment at age 25 or so. You find that perfect someone for the first time at age 26, get married. Age 27, you have your first child. Your income grows, your needs grow. You're certainly spending money, and you want to get that first home. So around 32, 33, you do that. As you, of course, are making more money, you're consuming more, your kids are growing, maybe you have another child, you certainly want more space, your kids want more space, you need more space, and around that early 42, 43 or so, you get that second or trade-up home. This is the McMansion period, if you will. You're hemorrhaging money through your 40s until finally, on average, you peak in your overall family spending in your late 40s. From there, eventually as your kids leave the nest, and you can finally look down this path to potentially somewhere in your 60s, or maybe later, some retirement. But you've accumulated all these things through your whole family growth cycle, and now what do you want to do? You want to get out of debt, pay down debt, deleverage if you will. You certainly don't need as much stuff. You don't need another big mortgage. And so you tend to spend less money as you age. A couple key points: at age early 50s, you might go out and buy that resort home, that vacation home, for some reason to lure your kids back in the nest that have left. Around 63, 65 or so, you may get that retirement home. But you can see by this chart, the left side is great for the economy, right? Because you're spending money, you're doing it on leverage because you're borrowing to do that. When you get over here to the right side of this, as you're spending less, that might be really great for the capital markets because you're saving money. you're putting that money into the bank or into investments, and so that's lots of capital for businesses and governments to borrow. But if you're not consuming money for businesses to actually make something to sell it to you, what's happening to the economy? So again, the left side of this, as you're growing and put together your necessary family spending, great for the economy. When you're saving and you're deleveraging, how is that good for the economy? It's not. And we're going to be talking a little bit here in just a few minutes of what kind of cycle we've been through in the 70s and 80s and all the way into the 90s and 2000s with this whole baby boom generation spending money all the way up into the point where they're just not. So if you take that first chart that we looked at, and this is by Harry Dent, Dent Research, he simply took the immigration adjusted birth index, colored it red, pushed it forward to peak spending. Now, you can see there's this yellow line here, that's a Dow adjusted for inflation. It kind of makes some sense, right? That is, the economy has the most amount of peak spenders in the economy, then you'd have that reflected in the economy, and eventually the markets would catch up to that, right? And the fewer peak spenders you have in the economy, that would be reflected in the Dow averages as you're seeing here. When you get to tops like we saw here from 2000, 2007 to potentially now, you get a lot of high volatility in the marketplace, as you can see by this. But if you're trying to figure out here where that point is, where you have the fewer peak spenders in the economy, that's around the early 2020s, 2020 to 2022. And then that resumes from the echo boom generation, which we'll talk towards the end of this brief talk. So, but we're not alone here in the United States. 330 some odd million people, but there's 7 billion in the world. This chart comes from Goldman Sachs, and one of my favorite charts, it shows here just a couple years ago what the share of countries around the world in the world's GDP. And you can see here that about 70% of the world's GDP came from the large developed countries such as the United States and Europe. The indebted countries today with actually quite mature populations too. But the balance being made up by emerging markets and developing markets in China, Brazil, India, Indonesia, Micronesia, Southeast Asia, these countries have much better demographics and are growing quite quickly. Fast forward, according to Goldman Sachs, in 2035, it just about flip-flops between the share of GDP for the developing world today and the emerging market world to the then older developed market world, the United States and Europe in particular, a dramatic difference. And it probably doesn't take too much statistics to tell you how you get there from here. Well, a quick little history lesson here. The Industrial Revolution, arguably one of the first big capitalist pushes, if you will, in the world, started in the mid-1700s in Europe. It took 150 years for per capita GDP to double. The second half of the Industrial Revolution happened here in the United States, and it started about 1900. It took approximately 50 years for per capita GDP to double. This decade, it took India just 16 or just this century, I'd say, it took India just 16 years per capita GDP to double and 12 years for China. Now, those are amazing numbers in themselves, but you want to think about the force behind these numbers. Back in the first phase of the Industrial Revolution in Europe, there was about 10 million people. After 150 years, there was about 37 million people. In the United States, we began with about 76 million people, and 50 years later, we had 150 million people. But in this century, India and China combined are about 2.4, 2.5 billion people. Growing at that incredible rate is truly astounding. In fact, according to McKinsey Institute, it wasn't until 1990 that you had 1 billion consumers in the whole world. And today, you have about 2.4 billion consumers. Now, what's a consumer? Consumer is making $10 or more a day. Certainly doesn't sound like a lot of money here in the United States. It's a couple Starbucks, but for lots of people in the world, that's the point where you can start to buy something other than just trying to survive, just struggling for food. You can actually go out and buy a consumer item. Well, fast forward, according to McKinsey Institute, in 2025, this is just a handful of, 12 years from today, they estimate that there will be 4.2 2 billion consumers in the world. For the first time in human history, there'll be more than half of the world's population will be a consumer. They also estimate by then there'll be 1 billion people making $20,000 or more a year, and 70% of those will be in these developing, emerging market countries. So truly, when you think demographics, we can't just necessarily think here in the United States. We have to think very much globally. After all, the S&P 500, more than half of their revenues are generated outside of the United States. Now, you can have a lot of fun with the demographic information or consumer information that comes from this Bureau of Labor statistic that we first started talking about, all the way down this very micro detail information. So let me ask you this before I advance this slide. What do you think the average age of the head of household is when potato chip sales peak, salty snacks? What is that? Well, it just so happens to be age 41. Okay, you got a bunch of 40-year-olds sitting around the couch packing in the chips, right? Well, sounds pretty good, but what's actually happening, remember you got married at age 26 on average, at 27 you have your first child. 14 years later, when that child's at the peak caloric intake of its life, hopefully, but that's what the statistics are, you're buying the chips because they don't have any money, and hence there you go, 41. Now, think about your midlife crisis. What do? You go out and do something stupid like have an extramarital affair, or go out and get a race car or a sports car or a fast boat or whatever, or you get what? A motorcycle. So here you see there's a very specific demographic demand for very expensive bikes, motorcycles, right again at that midlife crisis point, in your late 40s and early 50s. Now, I don't know what happens necessarily at age 60 or 70. The chart says it's flatline. I don't know. So hopefully you survive. But you still want to be on the road with something potentially a lot bigger, maybe something with a bed, bath, and a bar. What do you get? You get yourself an RV. Now, these things are very expensive, $100,000, $200,000, very expensive to maintain, to drive and store and all that, but there's a very specific demographic demand in the late 50s to our early 60s. Winnebago knows this. Sales have quadrupled in the last 4 years for Winnebago. Now, cars too. We could have talked about this several years ago when we were at the bottom of the Great Recession, if you want to call it that, in 2007, 2008, going to 2009. That car sales came back down to 11 million units per annum here in the United States, down from 17 million. Well, today, those car sales have actually resumed quite well. We're over 15.5 at a million rate. What you can see here, the early 50s is when car sales, or the most amount of money we spend on cars, is at that age. So maybe you're buying one for yourself because as a baby boomer, you've been raising your child, driving something that you wanted to replace for years but couldn't, or couldn't afford it. Certainly didn't want to get a new car with your teenager driving around. They're out of the nest. You finally have a little bit of disposable income. You want to get a new car. You do so. Maybe you buy two, because maybe you got one for yourself. Maybe you get one for your child that's returned back from college and you really want to just put them in it and send them away. Who knows? But one of my favorite slides here is men's shirts or men's apparel. For some reason, it does peak in our early 50s also. Now think about your grandfather. Hopefully he's still with us. You went to go visit him, and there he is sitting on his favorite chair. He's in his brown plaid shirt. Probably smells because he doesn't bathe. You know, the water sales tend to go down as we age also, by the way. Maybe flush the toilet a few times, but certainly water use does go down as we age. I digress, but he's sitting there in his brown plaid shirt, and what's he doing all day? Well, he's doing lots of drugs. He needs the drugs particularly to stay alive. These aren't necessarily recreational drugs, I hope not, but they are pharmaceutical drugs that he is, again, trying to stay alive. Now, these pharmaceutical companies know this, and they know they have a wave of business coming towards them. In fact, it's very easy to take, as we can see here, the immigration adjusted birth index simply lagged forward or pushed forward to our peak consumption of healthcare services, which is in the last couple years of our life. Here you can see that this massive baby boom generation, again, peaking in 1957-61, but starting way back there into the 30s is now pushed forward. So this is what's looking like for this wave of healthcare demand, really starting in a gusto here, just in a couple of years from now, and it really goes straight up well into the 2030s. So however we're going to deliver healthcare to the United States here, a chart like this certainly has to tell us we need to be a heck of a lot more efficient at providing this, because this demand is coming. It's actually astounding, the amount of healthcare demand that's coming. Now let's talk about, this is our last slide here. Thanks for hanging here with me through this whole demographic presentation. But this is, again, this is where things look lots better. You're looking out into the early 2020s, all the way out to the end of the 2030s, when finally this echo boom generation, the baby boomers' kids, are reaching into their peak spending. And that wave of these births comes peaking again. 1991 goes right out there into the 2030s. So whatever you've called your children today as you've been raising them, they are going to be our saviors here in the United States as you look out from early 2020s out to the 2030s. Now put that on top of a developing world, emerging market world with all those incredible demographics, which I'll talk about more in another video. But it is truly astounding, I believe, on the opportunities for not just what we're going to see here for potentially for prices for real estate and stock prices way out there, but also I would also, as we'll talk about in another video which you can find here, about what kind of impact that's going to have on inflation also, with all of that huge aggregate demand coming with potentially some tighter natural resources and of course an incredible amount of debt that's been accumulated by the developing economies here in the world. So again, my name is Doug Robinson, and thank you very much for viewing this. Thank you.